Hello everyone, in today's video, we want to talk about why the market moves and explain liquidity to its simplest form. So as you can see on my screen, the market moves because of money flowing in and out in trading. This money that flows is called liquidity. I would like us to think of it in this aspect. The amount of buyers and sellers available in the market, because without liquidity, trades cannot happen. When you think about liquidity, what should come first to your mind? Money. Because without money in the market, candles can't move. So whenever you enter the chart, you should always know that, okay, in this market, money moves this market. And you ask yourself, the money I have with me, can it move the market? And if no, then what you should be planning in your mind is buying with those whose money can move the market. So moving forward, let's take an example. Let's imagine a marketplace where people buy tomatoes, price goes up, and when you want to sell tomato back, the price goes down. You can also look at it in another way, because forex is typically like that also. If you buy a gold chain for maybe 5 million and you want to sell it back, I'm definitely sure you can't sell it back for that amount, depending on if you are patient enough to make the gold appreciate. When selling things back, you tend to lose money. Sometimes you can see the ask price might be high and the bid price might be low. If there are more buyers than sellers for EUR/USD, price rises. If there are more sellers than buyers, price falls. So this is trying to tell you that the market is engineered to follow people who has the large money volume. And as long as we don't have the large money volume, we have to follow those who has the large money volume. So when they are buying, we are buying. When they are selling, we are selling. That's how you can be profitable in the market. When you analyze the market, when you analyze the chart, then you wait to observe. That's why I tell people sometimes that time in trading often matters too. Because you have to try to buy when the big players are buying. You don't just buy when the market is weak and not having strong momentum. Moving forward, we want to know what big traders need. And who are the big traders? Just like we said in our last class yesterday. The big traders are the banks, institutions, hedge funds, and so on. So they trade with huge amounts of money. They cannot enter trade randomly. And what do they need? They need buyers to sell to, and they need sellers to buy from. So what comes to your mind right now? I'm sure you are getting this point. That's why price move towards areas where many traders place stop losses, buy stops, sell stops. So like you see, just what you read, buyers to sell to and sellers to buy from. So before a bank or an institution will enter a buy position or a sell position, they are going to look into the market. Look for the closest points where they know that, yes, at this point, buyers are here. Then they will sell. And look at this point, they see that sellers are here. Then they will buy. But before doing that, let's move forward. You can see where liquidity is found. Liquidity is usually sitting where? Above highs, below lows, around equal highs or lows, near support and resistance during news events. These are places where liquidity are being spotted, because many real traders place stop losses there. So it's very obvious. It's not like as if your broker is scamming you or they know where my liquidity is kept. It's very. I made a video telling people about where we keep our stop losses. If you can check my YouTube, you are going to see that video where people keep their stop losses. It's very obvious. If I'm trading, you can just come from anywhere and see my chart and tell me that, yes, this is the place you're going to keep your stop loss. And I'm going to keep my stop loss there. Because I don't have the large money to start looking for another place to keep my stop loss, or giving my trade enough breathing space, because I'm following discipline and I'm following proper risk management. So moving forward, in an example where we say liquidity grab, price forms a resistance. And what do many traders do? They sell at resistance. That's what we are all taught and our textbook knowledge. Put stop losses above the highs. And then what happens after that? Big traders may push price slightly above the high, trigger stop losses, collect liquidity, then reverse price downward. This is called liquidity sweep, stop hunt, liquidity grab. Okay, now let's explain this. This is when you see your trade, when you see yourself being stopped out on a perfect trade and the trade later goes your direction. So this is what should come to your mind. The place you are putting your stop loss above a resistant level, they definitely know that yes, this is where stop losses are going to lie. And sometimes you might see an entry. I don't want to go deep into this because of some that are just starting and just trying to understand the market. You see an entry, and at that point you see a trader marking this place as a liquidity sweep and putting his entry above that point. And when you see price going above that point and sweeping the point where he marked out liquidity sweep, the price rallies down again. It doesn't work all the time also, but he has built his own strategy to be so. And each time he sees that, that's when he trades or she trades. Let's move forward. Why candles move fast sometimes? Fast movement happens when big money enters, news release happens, stop losses are triggered together, and sudden flow of orders creates explosive candles. Okay, let's take it one by one. Big money enters. Where do big money enter? Big money enters in sections like London/NY section. That's where big money is being injected into the market, about 3 trillion. So these are the right time to trade. You looking for trade at midnight? I'm not saying you cannot trade at midnight, but you looking for trade at midnight, I see it as just stress. You have to follow where and when the big ballers are trading. So when money enters the market makes a huge move. When news are being released, just like the FMC news, FOMC news like NFP, I know that you'll be hearing news like that. That's why I said download your investing.com so you can be updated towards any news event at all. Stop losses are being triggered together. When losses are being triggered, trust me, even these banks lose money. These hedge funds, they lose money. So when losses are being triggered together, both retail traders, bank stop losses, anybody, all of us are just like hunters in the market. We are like hunters. Citibank can sweep out another bank out of the market if the bank doesn't trade right or doesn't trade well or just make a little mistake. So there's no one that doesn't lose money. Everyone lose money in the market. Just like our day-to-day life is, we all lose money. But what matters is how well do you win than your losses. That's what makes you profitable. And what do we see last year? That sudden flow of orders creates explosive candles. When you see all this thing happen in the market, that's when you see a big move. Maybe one candle can make a move that can break a structure and make a new high. When these things happens, moving forward, these are the key ideas every trader must understand. Price is not moving randomly. The market is constantly searching for what? Liquidity, orders, areas with many traders trapped. So this is what you should be always looking out for when you are trading. Look for liquidity where you feel like orders are being kept, because these hedge funds, they keep orders. That's why when you see, we'll go into that, all of that. I don't want to make this more broad, because all these hedge funds, all these banks, they keep orders where you see fair value gaps and other blocks. Then they come back maybe in the next trading day and come back, tap at those points and pick off. But still on those points, they still sweep liquidity. But sometimes they just tap those points and pick off. They fill up those orders back. So these areas which many traders are being trapped. That's why understanding liquidity helps you. Avoid fake breakouts, catch reversals, understand manipulation, trade with smarter timing. So this is what helps you. You trade smarter, you understand what manipulation are, you don't just complain or blame your mistakes on people. You catch reversals when you see that, okay, that the big players are trying to come and fill up their orders. You join them to fill it up and you buy with them or sell with them. You avoid fake breakouts. You know what fake breakouts are? That this breakout is just a liquidity sweep, when you understand what liquidity sweep really entails. So this, I want us to end with this mindset. Instead of asking, where is price going? You should be able to ask, where is the liquidity? Because price often move towards liquidity first before the real move. That's what you should know. Before any real move can happen, there must be liquidity that is being injected, or money that has been injected or taken from traders or people to make that big move. Because we all know that now, we know that market is being moved by money. So our summary of today is that we should just take this home and write it in our journal or in our note. The market moves because buyers and sellers create liquidity, and big traders push price towards areas where many others are sitting. So this is what should be our take home, and we should reflect on this and try to dig in deep on this topic. I'll be open to conversations. If you want to reach out, you can check my YouTube, see my WhatsApp contacts, Telegram, and any other place you can contact me, Instagram and so on. You can make this understandable to you more if you are willing to learn more about this, if you watch this video to this point. And in our next class, we are going to be treating buy versus sell explained just like a story. So thank you very much for watching. See you all in our next video.